If you're listening to this, chances are you've moved past the beginner charts, you know what a moving average is, and let's be honest, you're hungry for that advanced toolkit.
Yeah.
The concepts that really separate the institutional desk from the retail screens.
Exactly.
Welcome to the deep dive. Today, we are taking a massive stack of source material on advanced technical analysis and boiling it all down for you. Our mission is to give you a shortcut straight to two critical concepts: market structure and order flow.
Right.
Because these don't just show you what the price is doing, they start to reveal why it's doing it, which can just drastically refine your timing.
It really can. We're drilling into the core mechanics here. Think of it like this. Market structure gives you the map, the fundamental layout of the land.
Okay.
But order flow, that's your real-time GPS. It shows the speed and, the intent of all the major players on that map.
I like that analogy.
And understanding how those two interact, that's the crucial context you need, especially when things get volatile.
Okay, so let's start with the map then. What exactly are we looking for when we talk about market structure? I mean, beyond just simple trends.
Well, it's the architectural diagram of the market. But we're not just looking for pretty lines on a chart. We're identifying the critical liquidity zones.
Liquidity zones.
Yeah. For a professional, structure isn't just about where the price has bounced before. It's about understanding where the largest concentrations of resting orders are waiting. That's what really determines if the market is stable or unstable.
So it's about figuring out where the big money has already placed its bets.
Precisely. And we can break that down into four key elements. First is the trend, which everyone knows. But the advanced part is spotting trend exhaustion.
Okay, so when it's running out of steam.
Exactly. Are the higher highs getting weaker? Is the volume fading on the up moves? That structural weakening is a huge tell.
I see.
Second, you have consolidation. This isn't just the market being boring, it's the market reloading. It's a tight sideways range where large players are often quietly accumulating or distributing positions.
Without tipping their hand to the rest of the market.
Right. It's a structurally necessary pause for the next major move.
And then, of course, the classics, support and resistance levels. But again, how does an advanced trader view these? They're not just random lines, are they?
No, not at all. They're critical, psychological, and more importantly, functional barriers. A support level is where strong buying pressure is expected to show up. For our purposes, these are where institutional stop losses or massive limit buy orders are clustered. Price is literally drawn to these levels because that's where the liquidity is.
Got it. And the final piece.
Breakouts. These are the big structural shifts. When price moves decisively beyond a key level, it signals the balance of power has fundamentally changed. It forces a cascade of liquidations or new entries. It's the start of a new phase.
So market structure gives us where the high probability locations for a big move, but that structure is just a static map until the money starts moving.
Exactly.
Which brings us to the engine. Order flow. How do we define that in the simplest terms?
If structure is the historical mat, order flow is the real-time radar. It's showing you the actions of every single vehicle on the road right now.
Okay.
It's the literal process of orders being placed and filled. It reveals, moment by moment, how aggressive the buyers and sellers are.
And it's this granular view that's so valuable.
That's the key. You can actually see the actions of the aggressors, the people hitting buy or sell at the market price, versus the passive players who are just waiting with limit orders. You're tracking the number, the size, and the imbalance between them.
You're looking for the institutional fingerprint.
You're looking for the fingerprints.
That makes perfect sense. But let's talk about the tools, because I know a lot of people find them overwhelming. You look at something like the order book, and it's just a blizzard of numbers.
It is.
What's the real signal in all that noise?
With the order book, which shows all the pending limit orders, you're looking for anomalies. You're looking for unusually large walls of orders on one side. Now, that could be a genuine institutional level, or it could be something called spoofing, where someone places a huge order they never intend to fill just to manipulate perception.
Right, to scare the market.
Exactly. So the order book shows potential action, but then you have the time and sales tape.
Yeah.
The tape. That shows you the actual action.
And what's already happened.
What's already happened, and crucially, who the aggressor was. If a trade prints green at the ask price, a buyer was aggressive. If it prints red at the bid, a seller was aggressive.
And this is where we can spot things like huge block trades.
Huge block trades, yes. And something even more important, order absorption.
Okay, order absorption, let's define that. That feels like a key piece of jargon.
It is the critical insight. Absorption is when you see a huge, sustained amount of aggressive selling hitting the market, but the price doesn't drop. It means there's a massive, hidden, passive buyer just sitting there, soaking up all that selling pressure like a sponge. It's a massive sign of institutional conviction at a specific price.
Wow, so that's the difference between just seeing high volume and actually understanding what that volume means.
That is exactly.
Which brings us perfectly to the synergy. If structure is the map and flow is the real-time engine, why is combining them so vital? Why not just use one?
Because structure tells you where the pressure points are, and flow tells you if that pressure is real or fake. Combining them gives you true confidence. The research points to 4 huge benefits for you as a trader. First, price action analysis. Structure points you to the battleground, say that $110 resistance level. But order flow helps you see who's winning the battle in real time at that level. Are buyers getting absorbed, or are they breaking through? It helps you make the call.
And second, there's volume and liquidity insights. Everyone looks at a volume bar, but order flow tells you about the quality of that volume, the imbalance.
Right. An imbalance isn't just a volume spike. It's a major difference between aggressive buy volume and aggressive sell volume. A huge imbalance in one direction suggests an immediate price move is coming. You're tracking the velocity of institutional money.
Third, and this is probably the most important for survival, risk management. How does this help us define our risk?
It lets you place smarter, safer stop losses. If you know that a key support level is being defended by huge passive buy orders, you can see the absorption. You can place your stop loss behind that institutional wall of money.
So you're basically hiding behind the big guys.
You're increasing the odds that your position will be protected by that underlying demand. It's not a guess anymore.
And finally, what about the thing every trader fears? The false breakout, the fake out. How does flow help with that?
By confirming the commitment. A breakout on the chart that isn't backed by a huge surge in aggressive order flow, a flood of buy orders, a big positive delta, is probably a trap.
I see.
The flow provides the real-time evidence. It's the difference between hoping the breakout is real and actually seeing the proof.
That leads us perfectly into the actionable framework. We've distilled a 5-step playbook from the sources on how you actually connect the map to the radar.
Okay, step 1. Identify key levels. This is pure structure analysis. You find your historical support and resistance, but then you immediately look at the order book at those levels to see if there's any significant liquidity already waiting there. You're confirming its strength.
Step 2. Monitor order book and volume. So as the price gets close to those key levels, you're glued to the flow. You're looking for those anomalies, for absorption, for large resting orders, anything that signals institutional intent.
Step 3 is watch for breakouts and imbalances. If the price starts to break a level, you check the imbalance. A real breakout has to be driven by a sudden, decisive shift. You need to see that flood of orders that just overwhelms the other side.
If the price moves, but the flow is flat, it's a red flag.
A huge red flag. It's suspicious.
Step 4. Enter the trade. So you only execute after the price has cleared the level and the order flow has confirmed it. Then you place your stop loss just behind that newly confirmed structural level, protected by that liquidity you saw.
And finally, step 5, and people forget this one, exit the trade. You don't stop watching the flow once you're in the trade. You constantly monitor for exhaustion.
For the momentum to fade.
Exactly. If you're long and you see the aggressive buying start to dry up, or a huge wall of sell orders appears above you, that's your signal. That's the flow telling you the party might be over. You get out.
This framework is so powerful. Let's make it concrete with that case study from the sources. The example of Jack and the volatile stock XYZ Corporation.
Right, so Jack was looking at XYZ. His structural analysis, step 1, showed it had been consolidating for weeks, just stuck between $100 and $110. That $110 level was a very strong, very clear resistance. The structure said, wait for a break of $110?
The location was set. So then he switched to monitoring the real-time flow.
He did. As the stock crept up toward $110, he went to step 2. He watched the order book and noticed a big buildup of buy orders just below $110. But even more importantly, he saw order absorption on the tape. Aggressive sellers kept hitting it at $110, but the price just wouldn't drop.
So the big buyers were just quietly soaking it all up, getting ready.
Precisely, they were loading up.
Right.
So when the price finally ticked above $110, Jack didn't just jump in, he waited for confirmation.
Step 3.
Step 3. He saw a massive, immediate flood of aggressive buy orders hit the tape, a huge positive delta. The breakout was real. So he entered his long position at $111.
And what about his risk management? The stop loss.
He placed it strategically at $109, just below that old resistance level, which was now confirmed support and was protected by that absorption zone he had already identified. His risk was defined by the data.
Brilliant. And how did he know when to get out? How did the flow help him exit?
Well, the stock ran all the way to $120. He was trailing his stop, but he was also watching the flow. Right as it hit that big psychological number, he saw two things: a sudden surge in aggressive sell orders hitting the tape, and a big new wall of sell limit orders appearing in the book just above $120.
The momentum was flipping.
The flow was telling him the big buyers were now becoming the big sellers. They were taking their profits. He didn't wait for the price to turn around. He exited immediately at $119 and locked in his profit.
That is just the perfect illustration of synergy. He used the structure, $110, to find the opportunity, and then he used the real-time flow, the absorption, the flood of orders, the fade to confirm both his entry and his exit.
That's what it's all about. It's about gaining that deeper understanding of price dynamics. You're capitalizing on the supply and demand imbalances, which is, the only real way to gain a structural edge in these markets.
Now, a brief but essential reminder from all the sources we consulted today. Trading financial instruments involves a significant risk of capital loss. Market volatility is real, and you could lose more than your initial investment. This content is strictly for educational purposes. You should always perform your own due diligence, and please consult a licensed professional before making any investment decisions.
And with that necessary guidance in place, let's leave you with one final thought to mull over. If order flow reveals the real-time, immediate intent of the big institutions, and market structure defines the historical levels where those actions going to happen.
Right.
What deeper psychological or economic factor causes these major shifts in sentiment, these floods and absorptions, to cluster so perfectly at the exact levels that were defined by structure in the past?
It's the ultimate chicken or egg question of the market, isn't it? Does structure dictate the flow, or does the flow ultimately create and redefine the structure?
Something to think about.
Definitely something to think about as you start your own deep dive into the charts. We'll see you next time.